Good morning. These are the things that matter most in Europe's market today. The AI trade is splitting between real capacity demand and crowded valuation risk. Oil is back as a margin shock. Airbus is testing whether European industrials can keep delivery credibility. And one underappreciated healthcare story is moving from obesity drug excitement into access, pricing and policy. The question for private investors is not whether the headlines are big. It is which European baskets can prove earnings power while the market gets more selective. First, AI is still powerful, but it is no longer one simple trade. Microsoft rose as it lifted capital spending plans, Meta framed the same issue as an AI capacity dilemma, and Samsung showed strong AI chip demand. That is supportive for infrastructure. But the read-through for Europe is more complicated because ASML, SAP, and Infineon sit at different points in the chain. ASML needs investors to believe chip equipment demand remains durable. SAP needs AI to strengthen cloud growth without damaging margins. Infineon needs the cycle to broaden beyond the narrow data center winners. Winners are companies with visible demand, pricing power, and infrastructure bottlenecks. Pressure sits with high multiple technology and semiconductor names where expectations already assumed perfect AI execution. The private investor takeaway is simple: AI is not dead, but Europe now needs proof by company, not proof by slogan. Second, oil risk is back as a Europe-wide margin test. CNBC reported US strikes on Iran after a missile attack, and the Financial Times highlighted precariously low US inventories as supply disruption raises the stakes. For Europe, this is not only about energy shares. Shell, BP, and TotalEnergies can benefit if crude stays firm, but airlines, chemicals, and transport face the opposite side of the move. Ryanair, IAG, BASF, and Covstro are the pressure map if fuel and input costs move faster than demand. Winners are the large integrated energy names and selected service exposures. Pressure is in airlines, chemicals, and energy-intensive industrials if the crude move becomes a tax on margins. For private investors, the useful filter is whether oil strength leads the index, or whether it quietly tightens conditions for the rest of Europe. Third, Airbus puts European industrial credibility on the tape. Management is speaking about earnings, M&A, and tariff impacts, while delivery targets remain central to the story. This matters because Airbus is not just one stock. It is a signal for aerospace suppliers, manufacturing discipline, and Europe's ability to defend margins in a noisier trade environment. Safran and MTU Aero Engines are direct confirmation names, while broader industrial sentiment depends on whether delivery discipline offsets tariff and supply chain friction. Winners are companies with backlog visibility, pricing discipline, and supplier delivery. Pressure is on names where tariff costs, delays, or cash conversion disappoint. The private investor takeaway is to separate order book strength from execution risk. A full backlog only helps if it converts into deliveries, margins, and cash. The underappreciated story is healthcare access. Novo Nordisk rose after reports around EU Wegovy pill approval and a US access arrangement, and the company is also expanding access partnerships. That sounds like a product headline, but it may become a policy and pricing story. If obesity drugs move from scarcity and hype into broader reimbursement, the market will test who owns defensible pricing, supply and distribution. Novo Nordisk is the anchor, but Roche and selected healthcare distributors belong on the confirmation map. Winners are companies with clinical differentiation, scale, and access to payers. Pressure sits with crowded GLP-1 expectations if broader access means tougher pricing debates. For private investors, the takeaway is that the obesity drug trade may be shifting from demand excitement to monetization quality. That can reward leaders, but it can also expose overconfident valuation assumptions. Here is the stock-led watch list. ASML, SAP, and Infineon. Does AI capacity demand support Europe, or does valuation discipline dominate? Shell, BP, and TotalEnergies. Does oil strength lead, or do airlines and chemicals absorb the pressure? Airbus, Safran, and MTU Aero Engines. Do deliveries and margins confirm industrial strength? Novo Nordisk, Roche, and Fresenius. Does obesity drug access improve the earnings path, or raise pricing scrutiny. Market bias, selective, Europe first and confirmation-driven. There are clear potential winners, but the market is likely to reward evident rather than broad themes. The regime is not risk-off across everything, it is proof first. The mistake to avoid is chasing the loudest headline before the relevant basket confirms it. Today's better filter is earnings quality, margin transmission, and whether the affected stocks move in the same direction as the story. That is the Europe Morning Market Brief. We will be back tomorrow with everything that matters. Research context only. This briefing is not investment advice.